And joining us right now to talk the markets and more is Savita Subramanian. She is head of U.S. equity and quantitative strategy at BofA Securities. Savita, thank you.
Thank you.
What do you think? First of all, July 4th holiday.
Yes.
We're getting ready to kind of take off, get out of town.
30.
No trading tomorrow. Where do you think we stand just right now with the markets?
I think things look pretty healthy. It's hard to be bearish on America right now, given that, the economy is really running at a very healthy clip. We've got CapEx taking off. We've got these hyperscalers providing that sort of stability of CapEx spend. I think the index itself looks a little bit, fraught in terms of just supply coming online, demand maybe, kind of pausing for a moment. But I think the economy is really the bright spot. And corporate earnings are actually gangbusters this year. I mean, I think we started the year above consensus at 15%. We're now tracking something like 20% earnings growth, which is basically a multiple on the average earnings growth. So I think we're in a really good spot in terms of corporate earnings. Where I see the real benefits are in some of the more GDP-sensitive companies in the S&P 500. So we've got the Fed telling us that maybe the economy isn't in terrible shape, and in fact, they might have to tighten. And by that token, that means that things are doing fine. In fact, they might be a little too hot. So I would be more bullish. And our view is go for cyclical companies that benefit from GDP growth. We're in a great nominal GDP environment, and that's the one area of the market that's still trading pretty cheap.
And that would be companies and sectors like what?
That would be industrials, energy, materials. Think about widgets. Like if you build stuff, you need the widgets to drive those things. So I think semiconductors, it makes sense that semis have done well this year. Doesn't make as much sense that they're selling off now. When you think about just machinery, engineering, construction, oil, metals, these are the areas that I think could do really well over the next, not just 12 months, but maybe the next few years.
The oil companies, the big oil companies at least, have come down just because oil prices have come down, given what's happening in the Middle East.
Geopolitical escalation and de-escalation, yeah. So I think that what's interesting is that oil companies actually started to outperform before the war. So they're really telling us that something else is going on. They started to work maybe mid to late last year. And what I think they're telling us is we're in a power bottleneck. We don't have enough power to fire up all these new tools that we're trying to build. And by that token, if you're in a manufacturing CapEx boom, you need to move stuff around, which means you need oil, gas. And I think that's the bull case. It's not necessarily just buy oil as a hedge against geopolitical risk. It's really the idea that oil just looks like it's undervalued. These energy companies have capital discipline. They're not spending at a really rapid clip. They're more focused on cash return. And I think that cash return and dividends are really important to look at right now.